Hey everyone, welcome in to another daily editorial here on the KE Report. We are chatting with Jeff Christian, managing partner at the CPM Group. Now, Jeff, earlier this week, CPM Group put out a video that really focused on central banks buying and selling of gold. It's something I wanted to focus on with you, and you even sent me the presentation. I'm going to pull a chart out of that presentation that shows net purchases and sales of gold when it comes to central banks, dating the whole way back to 2000. The first thing that really stands out to me is that we have seen a pretty distinct shift in net selling that we saw from 2000 to 2010, and now consistently net buying throughout the last about 13-year period. Majority were in net purchases here. Central banks continue to build gold reserves and buy gold. Jeff, what caused that shift in 2010 to switch central banks to be net buyers of gold?
Well, yeah, to understand it, you have to understand there are really two groups of central banks. There are central banks at developed countries that were major trading nations prior to 1971. And during that period of time, governments settled their currency imbalances with gold. So if you had dollars, you would take them to the U.S. Treasury and say, you know, the dollar is $6 to $35 an ounce of gold. Here's my dollars. Give me your gold. So gold was used for trade settlement purposes and capital flow settlement purposes prior to 1971. And the developed countries that were major trading nations back then accumulated a lot of gold, like 1.3 billion ounces of gold. After 1971, gold was no longer used in that fashion, and so it was basically a monetary reserve asset that wasn't used for trade settlement or capital flow settlement, or wasn't used to peg to the currencies or anything like that. And the central banks had 90, 95, 97% of their monetary reserves in gold, which they no longer needed. They needed dollars for trade settlement. And so they started selling gold to raise dollars. And that trend really went from like 1972 through 2010. And in that chart that you referred to, you can see the ending of this very long period of gold demonetization, it was called. Central banks that had accumulated and had most of their monetary reserves in gold, diversifying their monetary reserves by selling some of their gold. A lot of them sold half of their gold. Switzerland, the UK, various other European countries sold half of their gold. A few of them, a couple countries sold all of their gold or more than half of their gold. They were diversifying their monetary reserves by selling gold and building up foreign currency reserves. By 2010, most of the central banks that had wanted to sell gold had sold most of the gold they wanted to sell. And you saw a trailing off really from 2006, 2007 into 2010 of that program. Now, that's one set of central banks. The other set of central banks are central banks of China, South Korea, Southeast Asian countries, the Philippines, that were not major trading nations during the gold standard era and did not have a lot of gold in their monetary reserves. But they became the Asian tigers. You also had oil producing nations that all of a sudden started having enormous capital flows when the oil price went from $1 a barrel to $40 a barrel. And those countries did not have a lot of gold in their reserves, but they had this massive inflow of US dollars. So they had 80, 90, 95% of their monetary reserves in dollars. They wanted to diversify their monetary reserves, and so they were selling dollars and buying gold and other currencies. That really picked up after around 2008, 2009. And since 2008, 2009, you've seen those central banks buying a lot of gold, and the central banks that had been selling gold, selling very little gold because, they sold what they had wanted to sell. So you had this big shift around 2010 where all of a sudden you went from 40 years of net selling consistently on the part of central banks as a group to net buying by central banks as a group. You still have some residual selling, and you saw like about 4 or 5 million ounces of gold sold on a gross basis by various governments last year, primarily 3 governments that ran short of foreign currency and needed to sell some of their gold reserves to raise dollars to pay for their imports. But so we've seen this big shift, and it's the same impulse. Let me diversify my portfolio, my monetary reserves, but coming from different angles. The guys who were selling had most of their reserves in gold and wanted to build up their foreign currency reserves, 60% of which are U.S. dollars. And the guys who didn't have a lot of gold wanted to diversify their portfolio, 90% of which was U.S. dollars, by buying euros and yen and other currencies and gold.
Well, Jeff, with regards to central banks buying of gold over this time period, more recently, we've heard a lot of narratives, and we heard it again just in the conferences in Vancouver, that a lot of people point to the reserves they used to have, like you say, over 40, 50 years ago at higher levels before they started selling. And they are suggesting that they're going to keep adding, that central banks are going to keep buying to maybe get not to those same levels, but a lot higher than even where they are currently. So could you speak to where is the average holding of the central banks currently? And do you think that they'll keep adding to it to those historic levels, or are they more interested in other currencies, to your point?
Yeah, the bottom line is that they're more interested in other currencies. And one of the reasons why they're buying gold is because there's not enough liquidity in those other currencies to allow them to buy more for their monetary reserves. But yeah, if you go back to like 1977, 1978, central banks had about 62% of their monetary reserves in gold. And then from 1980 until 2006 or so, that dropped down to 10%. It's now up around 14%, 13 or 14%. And if you talk to central bankers, what you find is that is pretty much the sweet spot. You know, most central bankers want between 5, some central banks, if they have a lot of reserves like China, want like 2 to 5% of their monetary reserves in gold. Other central banks that don't have so much foreign exchange are interested in, say, 5 to 10 or 5 to 15%. So we expect central banks to continue to add gold to their reserves because we expect their reserves to continue to grow both in currency and in gold. But we don't necessarily see it going over 20%. For many years. We expect it to be relatively small. You know, the People's Bank of China made an announcement about their currency and gold policies in, I think it was 2014, it might have been 2015. And what they said was, we have, since the 1940s, thought of gold as a small but insignificant part of our monetary reserves. And we're changing that. And now going forward, we're going to see gold as a small but significant part of our reserves. And they have added a lot of gold to their reserves since 2008. Well, really since 2014. The People's Bank of China was buying some gold prior to 2008. When the price went over $1,000, they stood down for a few years. But then there was a lot of selling by institutional investors and others within China, say 2010 to 2014. So the People's Bank of China accumulated that gold. And then when they made this policy shift, which included greater flexibility in the yuan exchange rate, they said, you know, we're going to add, I think it was 14 million ounces of gold to our monetary reserves. And we're going to continue to buy gold. Most of the gold we buy from domestic refiners. It represents gold that they have refined either from domestic mine production or domestic scrap recovery, or gold recovered as a byproduct from copper, lead, and zinc concentrates, either domestic or imported. So we, the People's Bank of China, are buying gold within the Chinese market. And they have stepped outside of the Chinese market once or twice in the period since 2014, so the last 10 years. But mostly they buy from domestic refineries, domestic production. And that's sort of the way that a lot of these countries do. But they don't necessarily see 20 or 30% of their reserves being in gold. Anybody who says that is a gold buyer or a bug or producer who, just is voicing wishful thinking.
So, Jeff, how do you correlate this over to price fluctuations then? How big of a role does this central bank buying have on current prices and even what drives prices?
Yeah, they're not as important as private investors because they're more price elastic or price inelastic and price sensitive. So what you saw, as I said, there were central banks that were buying gold prior to 2008, but not a lot. And after 2008, when the price of gold went over $1,000, you started seeing more central banks buying more gold. So whereas the industrialized countries had sold low, these guys were buying high. And they have continued to buy high, 10, 15, 20 million ounces a year. They bought 20 million ounces a year once. They bought at 1 year around 2015 with the addition of that metal that I mentioned in China. The net addition of the gross addition of gold to central bank reserves was about 32 million ounces. But as I said, about 14 of that was the People's Bank of China. So what you see is that the central banks are more price sensitive. And when the price of gold started rising, they would pull back. And one of the significant developments we've seen over the last 3 years, 2021, 2022, 2023, was that central banks have shifted their attitude as to what a low gold price was. They were buying heavily when the price of gold was $1,250 to $1,350 in 2017, 2018, early 2019. When the price went over $1,350 in July of 2019, they pulled back sharply. But then the price, went to $1,600 and $1,800. It touched $2,000 on an intraday basis in 2020 and 2021, again in 2022, and again in 2023. And when the price came down to $1,680, which I believe was in late 2021, you saw central banks pick up their gold. And what that was showing us was that central banks had raised or elevated what they considered a bargain price for gold. So whereas they had been buying at $1,250, $1,350 and pulled back when it went over $1,350, when the price went from $2,000 down to $1,680 or $1,640 in 2021, central banks started buying. Okay, this is a good price. I think I might be wrong. I think that might have been in November and December of 2022, not 2021, when that happened. So you're seeing that central banks pay attention to the market and they say, okay, 1680 is a good price now. And what we've seen this year, or what we saw in 2023, was that central banks were picking up their purchases even though the price didn't go back to 1680. It went down to 1880, 1840, and central banks were buying gold. And there were several central banks that were buying significant portions of gold, more than a dozen. Now, half of the gross purchases that we saw by central banks last year was by the People's Bank of China. They bought about 7.3 million ounces of gold in 2023. The next largest purchaser was Poland at 4 million ounces. And if you saw 17, 18 million ounces of gross purchases, 7 of that was China.
Well, Jeff, another narrative that we hear in the space is the dichotomy between what central banks are doing by buying the gold and what everybody else is doing as far as retail or institutional buying. And a lot of people have pointed to that there were outflows in the GLD and SLV last year in 2023 as gold and silver were having little rallies throughout the year and at the end of the year. And that same thing in the years prior, that a lot of what it seems like the demand for the gold price has been underpinned, at least in the narratives that we hear in the sector, by the central bank buying. but that we're seeing the exact opposite with retail. We've talked to a lot of coin dealers and a lot of coin shops, and they said a lot of their inflows, a lot of their metals has been inflows, not outflows. People have been bringing them metal to sell. Well, how do you square the circle there as far as the central bank buying underpinning the gold price versus what retail and institutions are doing?
Yeah, the dichotomy is not central banks to private investors. The dichotomy, what we saw, and it's different from silver to gold. You mentioned silver, I think, in there. And in gold, there's a very interesting thing. There were about 6 million ounces of net disposals of gold held by ETFs in 2023. But investors bought about 24 million ounces of gold. What you saw in the gold market was investors were continuing to buy gold. They bought 24, 25, 26 million ounces per year over the last 3 years. So they were continuing to buy gold at pretty hefty levels. 24 million ounces of net investment demand was a pretty high level historically for net investment demand. But within that, you saw other investors saying, I don't want to have ETFs, I want to have bullion. I don't want to have shares in an offshore company, the sole value of which is its gold holdings, and which has a custodian, a manager, and an administrator, all of whom could cause problems, and it's not direct ownership of the gold. I can't, with almost all of those ETFs, say, here are my shares, give me my gold. I have to sell the shares and then take the proceeds and go buy gold from somebody else. So what we saw was 6 million ounces of outflow from ETFs, which were people saying, I don't want to have my gold exposure tied up in the financial system and banks and brokerage houses. I want to have my gold exposure direct to bullion. So some of those people who were selling 6 million ounces of gold ETF shares last year actually were taking the proceeds and buying physical gold and storing it in, either on their own or at depositories around the world. So that's the dichotomy you saw in gold in 2023, and that's a very important one, because what these investors were saying was, I'm not bearish on gold. I'm worried about exposure to the financial system. I don't want to have that financial system exposure in my gold. I want to be able to get the gold if something goes wrong with the financial system. Very important message, and very different from saying, oh, well, look, the ETFs have lost 6 million ounces of gold. Yeah, the ETFs lost 6 million ounces of gold because those people who were buying that gold said, hey, this isn't really gold. This is a share of an offshore company. Now, in silver, you have seen much more actual sales. And, investors continued to buy silver last year, but the amount of silver they bought on a net basis was way down. And that's because you had a lot of investors selling their silver. And I've said it's because of disenchantment. And you've seen any number of people on the internet say, I sold my silver because, people promised me it was going to be $100 or $700, and it's not. People promised me it was going to be $30, and it's not. So I've got to do it. I've gotten some interesting emails that say, it's not because I'm disenchanted, it's because I need the money. So you're seeing a lot of retail disenchantment with silver last year, and it's probably going to continue this year. And a lot of investors have been selling their silver, physical as well as ETFs.
Jeff, I find that very interesting what you're seeing within some of that gold buying. And the fundamental driver of gold is people losing faith in kind of the underlying banking system, which sounds like that's why at least some people were buying gold. What do you think about those stories we heard last year, though, of Costco and then even Walmart selling gold bars and apparently selling out very quickly? Does this carry over at all to, again, that narrative that you were seeing, people buying and storing gold, or just even more of a retail interest?
That's exactly what it is. And I will point out that in late 1979, Sears started selling gold and silver in its stores too. Yeah. So this is a phenomenon that we've seen in the past, which is retail department stores really, saying, oh, wow, people are buying gold and silver. Let us sell it to them. But it also is, as you say, it's a direct indication of the extent to which retail investors and retail people, consumers are saying, I should have some gold and I should have some silver, and it shouldn't be in a bank account someplace, or it shouldn't be in an ETF or a share of a company that owns this gold or silver for me. I should have it. And it represents, I think we're not supposed to use the word fear, but that's exactly what it is. It's significant concern about financial market, economic, and political stability.
All right, Jeff, very interesting. And it does sound like a fairly optimistic outlook for at least gold having some sort of floor in the price, too, because of the interest that we are seeing, not just from central banks, but also other investors. Hey, we have seen gold just continue to hold above 2,000 while seeming to not care what the markets are doing, even as markets have gone to all-time highs. So something we'll follow up with you on, and thank you for sharing some of your data on central banks, the shift that we've seen, and why they continue to buy gold. Jeff, we'll chat with you again next month. Have a great rest of your week.
You too. Take care.